Today, we need to dedicate the entire episode to the markets. A lot has been happening across asset classes, gold, equities, crypto, and the banking sector. There's fear, real fear, and investors are trying to make sense of what's driving it. As always, we'll separate facts from interpretations. We'll review what's actually happening, then discuss how these data points might fit together, so you can form your own opinion. Let's start with the asset that seems to be sending the loudest signal right now: gold. Over the past months, gold has shown one of its strongest performances in years. The price has climbed close to $4,380 per ounce and continues pushing toward $4,500. Technically speaking, this is a clear and accelerating uptrend. But beyond the chart, it's what gold represents that matters. It's often seen as a vote of no confidence in the monetary system. When investors sense that the financial architecture, central banks, currencies, fiscal balances may be under strain, gold tends to shine. It's not that people suddenly want jewelry. It's that they want safety and liquidity outside the system. Now, something interesting is happening. Speculators typically choose between gold and cryptocurrencies as alternative plays. But while Bitcoin and Ethereum are stuck in broad, choppy, sideways ranges, gold is trending sharply higher. For traders, gold right now offers something crypto doesn't: momentum. It's simply been easier to make money following the gold trend. However, these speculative flows can shift quickly. Once gold stops rising and starts consolidating, when we see that sideways phase or a sharp reversal, some of that capital is likely to rotate back into crypto assets. So gold's next pause could set the stage for the next leg up in Bitcoin and Ethereum. Next, let's talk about global liquidity, specifically M2, the broad money supply. If we aggregate M2 across the G7 economies, we see a steady upward trend. M2 isn't perfect, but it's a useful proxy for how much cash is circulating in the global financial system. When M2 rises, it often means that liquidity is abundant, and that tends to support asset prices, from stocks to commodities. Now, when we compare gold, M2, and Bitcoin, something stands out. Gold tends to move in sync with M2, almost as if it's shadowing global liquidity. Bitcoin usually lags behind. It reacts later after liquidity conditions start improving. That's why monitoring M2 is helpful. It tells us whether the overall tide of liquidity is rising or falling. And as long as the tide keeps rising, it's difficult to argue that we're in a deflationary or collapsing environment. But it's also important to note that this relationship can diverge short-term, especially when risk perception spikes, as it has recently. So, for now, gold is reflecting the macro liquidity story, while crypto is still waiting for confidence and risk appetite to return. Let's move to Wall Street. Yesterday, one of the most significant developments came from the regional banking sector. The ETF that tracks U.S. regional banks suffered a sharp decline, effectively breaking its recent uptrend. That move also pulled down the Russell 2000 index, where regional banks hold a major weighting. Now, why did this happen? Markets always look for a story, an excuse to justify the price action. The first explanation pointed to earnings results. Two U.S. banks reported losses in Q3, largely due to higher provisions for loan defaults. That triggered fear across the sector. At the same time, data show U.S. credit card balances have reached $1.3 trillion, with average interest rates exceeding 21%. That's historically high, and it raises concerns about consumer stress and potential defaults. But here's the thing: this information isn't new. Analysts already knew about rising consumer debt months ago. So, while the numbers are worrying, they may not fully explain the sudden market reaction. That leads us to another, deeper issue: liquidity inside the financial system. When a bank has excess cash, it can deposit it at the Federal Reserve through reverse repo operations. The Fed, in return, provides Treasury collateral and pays interest. Normally, the interest rate on these Fed operations is very close to the rate at which banks lend to each other in private repo markets. But lately, that spread has widened. In simple terms, that means liquidity is tightening. There's less cash circulating among U.S. banks. Currently, total reserves in the banking system stand near $3 trillion, the line many analysts consider the minimum safe level for smooth financial functioning. If reserves fall below that, funding stress tends to appear quickly. This is why Fed Chair Jerome Powell recently hinted that the central bank could end its balance sheet reduction, the so-called quantitative tightening, or QT, to prevent liquidity from drying up further. Globally, however, liquidity is still expanding, especially from Asia and Europe. That's why some analysts think the U.S. liquidity squeeze is temporary, not structural. But temporary or not, when liquidity tightens, markets feel it immediately, starting with the weakest links, like regional banks. One of the best ways to measure fear in the market is by looking at high-yield bond spreads, the extra interest investors demand to hold riskier debt. These spreads spiked slightly, but now they're falling again. That tells us something important. Even in one of the riskiest corners of the market, fear hasn't exploded. If investors truly believed a financial crisis was imminent, these spreads would be soaring. Since they're not, it suggests the current panic is likely overdone, consistent with the view that liquidity issues are temporary rather than systemic. Now let's turn to the S&P 500. The index recently broke below yesterday's lows, which is a bearish signal from a technical perspective. But context matters. Today also happens to be monthly options expiration day, when volatility often spikes and prices get distorted. Under normal circumstances, that kind of break would indicate short-term bearish sentiment. However, a quick recovery above yesterday's lows could signal the formation of a temporary bottom. At the same time, the CNN Fear and Greed Index shows investors are overwhelmingly fearful. Yet, the S&P 500 remains only about 3 to 3.5% below its all-time highs. That's remarkable. It means sentiment has deteriorated much faster than prices. And from a contrarian perspective, when everyone feels fear but prices haven't collapsed, the market may be setting up for a rebound. Still, confirmation must come from price action, not emotion. Let's move to crypto, starting with Bitcoin. Compared to gold, Bitcoin has been underperforming. Part of that is due to liquidity. Speculative money has been flowing into gold instead. Recently, we saw a massive liquidation of Bitcoin futures positions, the largest in history. That means leveraged traders were wiped out, leaving the market cleaner for the next move. However, several on-chain indicators show that miners and long-term holders, whales, have been sending coins to exchanges, often interpreted as selling pressure. In the short term, the trend remains downward. Option markets confirm this. Traders are paying unusually high premiums for put options, a sign of extreme fear. The key technical zone to watch lies between 100,000 and 106,000. That level acted as resistance in mid-2025 and support in late 2024. If Bitcoin stabilizes there and rebounds above 110,000, it would suggest a bottom formation. A simultaneous cool down in gold prices would further support the idea that speculative capital is rotating back into crypto. To summarize, gold continues to act as a safe haven and liquidity magnet. Global M2 growth supports long-term liquidity, even as U.S. reserves tighten. Regional bank weakness reflects temporary stress, not systemic collapse. Fear dominates sentiment, even though major indices remain near highs. Bitcoin is testing key support zones amid widespread panic. Fear is high, perhaps too high, but markets are complex systems. Our job is not to predict them, but to understand the forces behind the moves. So, take the data, analyze it, and form your own conclusions. As always, we'll keep watching the indicators and bring you the facts behind the noise.